You know, it's been some time since we've had one of these Outlook conferences where the opening presentation's actually been relatively positive. So I'm going to talk about the global macro story and what that means for global sovereigns, and both of them are actually pretty positive. I think we're in a favorable position with respect to where we are in the global economic cycle. If we look at commodity prices, they're not too high, not too low. They seem to be just right. Tightening of U.S. monetary policy, we have not seen any taper tantrums. We don't think we will see a taper tantrum. And the political calendar, it's never empty, but it looks a little bit better than it did a year ago, with fewer elections, certainly in the advanced economies. But we're in the risk business, so I'm going to talk to you about probably the key risk that we see starting to materialize in 2018. It'll be more evident in 2019, and that's, as is seen on the screen here, higher interest rates. What do higher interest rates mean for the world of global sovereigns? So let's get started. Just a quick two-part presentation. Essentially, I'm going to talk about macro, then I'm going to talk about the global sovereign outlook, and then I'm going to hopefully you will ask me a question or two, and then I'm going to ask you a question in terms of this voting slide at the end to rate the risks that you see, and that'll lead us into the panel discussion that follows. So here is a quick overview of a couple of the points that I'm going to make today. Global macro on the top half, and then the sovereign issues on the bottom half. So we'll start with the global macro. I don't want to spend a lot of time talking about three of these issues because we're more or less near the consensus view on a couple of them. Global growth, we see growth higher than potential growth in 2018 in the advanced economies. In almost every country we look at, we see higher growth this year than we saw last year. So the growth trajectory is quite positive. On China, I think we have a reasonably consensus view there as well, in the sense that the Chinese authorities are going to be managing the economy to a slower growth trajectory. We're not looking for a collapse of growth by any stretch in 2018, 2019. I think we'll probably pick up on China a little bit during the panel discussion. If you look at what the government announced as what they called their three battles for 2018, this was announced by President Xi: financial risk, reducing extreme poverty, and moving forward with some environmental issues. So you'll notice that growth isn't actually in there, but the 6.5%, around 6.5% target we still think is a driver of policy. But it's interesting that given that we've had growth so high for so long in China, they feel comfortable identifying a couple of other issues beyond growth as their policy priorities. On oil, we have it's a little bit low, I guess, where the price forecast that we've got for this year relative to where we are today, but we do believe there is a supply response which is quicker than it has been in the past, so we see oil prices drifting a little bit lower from where they are. But as I said, it's not really a factor that's going to be driving sovereign ratings either on the upside or the downside for 2018. Where we are a little bit different is really interest rates, where we see the Fed raising rates 4 times in 2018 and 3 times in 2019, so a little bit ahead of where the market is. In terms of the sovereign issues at the bottom of the chart there's a reasonably positive outlook as we move into 2018. The balance in terms of positive and negative outlooks is roughly equal, and I'll show you some charts on that and why we think that this is the case, and I'll give you a little bit of regional commentary as well. And the key risks that we're focused on for 2018. Interest rates, which I'll speak a little bit more about, and some of the fiscal challenges, which is the most important part for us from a sovereign rating perspective, that are associated with higher rates. Again, we probably won't see that in 2018, but we will in the years ahead. From a policy perspective, I'll talk a little bit about the U.S. because we think that's where the most policy risk lies, particularly with respect to trade policy. And on the political side, it's more of an emerging market election year than an advanced economy. So I'll talk a little bit about a couple of the countries where we see some of the higher risks in that context. So let's start with the macro story. Why do we have this view that the Fed will raise rates 4 times and 4 times this year, 3 times next year? What do we think the Fed's looking at? Well, they're looking at a lot of things, but here's 2. So the labor market, which is clearly near and dear to the hearts of the Fed, and financial conditions. So on the left-hand side, just got the unemployment rate and what's called the U6 unemployment rate, which is one of the alternative rates that a lot of people in the U.S. focus on. And on the right-hand side, you've got financial conditions index produced by the Chicago Fed. And a number of investment banks produce the same kind of indexes on the right-hand side. The direction of change is the same in all of them. It's downwards. So let's take a look at the labor market first. So if we have an unemployment rate, which is now around 4%, dipping to 3.8 or lower, we're back to unemployment rates that have not been seen in the U.S. since the 1960s. So that gives you an idea on one measure as to how tight the U.S. labor market is. Are we seeing wage increases accompanying that? Well, it depends which number you look at. If you look at the Atlanta Fed's wage tracker, which is one of the things that we do, that measures wages of people who've been in the same job for more than a year. That's been above 3% since 2015. So there is some evidence of a tighter labor market leading to higher wages. The business surveys of small business, 1/3 of small businesses now report at least one job which is hard to fill. That's the highest it's been in 15 years. The same surveys ask manufacturing and construction firms what their biggest challenge is in 2018. It's not taxes, it's not regulations, it's finding qualified workers. So there is a tightening of the labor market in the U.S., and I think there's a lot of other indicators you can look at to reach the same conclusion. Fed's very focused on the labor market, so this is one of the reasons why we believe that, that rates move higher from here. In terms of the financial conditions, which you can see on the right-hand side, even though policy rates have been moving higher, financial conditions have been easing. When that line goes down, financial conditions are easing. Part of that's the dollar, the weakness of the dollar last year, but also medium and long-term rates not moving higher. And there's equity prices are in there. So at some point, central banks, not just the Fed, have to start to change their calculus a little bit in terms of the kinds of policy errors that they're willing to take. And the risk of doing too little becomes greater than the risk of doing too much, especially with that kind of financial conditions indicator, and if you expect that to continue moving forward. So similar vein, what does the ECB see? We don't see the ECB acting this year, obviously, other than the winding down of the QE towards the end of the year, but not on policy rates. But what do they see? They also see a reasonable recovery story, and here's two things that they might be looking at. One is credit growth on the left-hand side. This is bank lending to households in the corporate sector. I've put on the larger economies, but you can put on virtually all of the Eurozone economies. You get the same pattern. In real terms, in the largest economies, credit growth is positive. On the right-hand side, government bond yields, 10-year yields. No surprises there. We've seen a compression of yields and a convergence of yields. So you could say from both of these perspectives, from where the ECB sits, sort of mission accomplished in terms of an easing of monetary policy. The recovery is underway, and if the sentiment was we'll do whatever it takes to preserve the integrity of the Eurozone, you look where yields were some time ago, and you could say that they've kind of done it. So the rationale for keeping interest rates and financial conditions exceptionally easy is disappearing. Obviously, central banks are more interested in inflation than anything else. So we don't see inflation accelerating from here, but gradually moving higher. There's a couple of reasons why labor markets might not have responded as aggressively as people think. We don't believe the Phillips curve is dead. There will be higher prices and wage increases going forward. Maybe we could talk about that either during the panel or in the questions afterwards. So where are we relative to the market in terms of policy interest rates? At least, I think the thing to focus on here is the end 2018 and then the end of 2019, rather than where the numbers are in between. The end 2018, we've got the Fed funds rate at 2.5%. Dot plot median's 2.1. The market Fed funds futures get you to 1.8. So we're a little bit higher than the market, as I mentioned, but really the message here is that it doesn't matter if you look at us or you look at the market or you look at the dot plots, interest rates are moving higher. That's the new world in which we will be living. If you think about which interest rates matter most for sovereign credit, it's not the policy rate, it's market rates. And it's not actually the market rate, the 10-year yield, it's the effective interest rate that governments pay. So as policy rates go up, The next more interesting question is what's going to happen to longer-term rates, and then what happens to the effective rate, and I'll come back to talk about that in a couple of minutes. So let's now talk about what higher interest rates might mean for sovereign credit in 2018 and beyond. Quick recap of where we are, where we've been, and where we think we're going in 2018. On the right-hand side, this shows you the trailing 12-month net upgrades by region. Couple of points to draw your attention to. One is the blue line, which kind of moves up very aggressively towards the end of last year. That's the developed markets. We had a flurry of upgrades in November and December. So given that this is a 12-month trailing number, that line will continue to be quite high as we go through 2018. We've got more positive outlooks than negative outlooks in the developed markets, which you can see on the left-hand side. So there's a reasonably positive story in terms of the rating momentum for the advanced economies, for the developed markets. Emerging markets, a little bit more mixed. You can see that it's less negative, certainly for the Middle East and Africa and Latin America, and we're starting to see some modest positive momentum in emerging Asia and in emerging Europe. So in Asia, the positive story there, and you can see on the left-hand side, we've still got 2 credits on positive outlook. We've upgraded Indonesia, we upgraded the Philippines in the last 2 or 3 months. We've still got a couple on positive outlook. If there's one region of the world which is leveraged more than any other to good global growth story, it's Asia. So we should expect to see that kind of trend there. In emerging Europe, similar positive story. The leverage to the Western or the advanced economies or the Eurozone good growth story, the likes of Poland and countries like that. But it's broader than that. We see a very strong growth story in the region supported by, again, that leverage from the developed markets as well as the policy framework being supportive. EU funding being very important for the larger economies as well, supporting domestic investment spending. What about Latin America and the Middle East? Well, Latin America, it's more balanced. The largest country, perhaps the most important in the region, Brazil, we still have it on a negative outlook. The fiscal challenges in Brazil have not been addressed, and I'll come back to this when I talk about the politics towards the end. And under almost any realistic scenario, debt to GDP in Brazil continues to go up. So this rating continues to be on negative outlook. Maybe we're getting towards the bottom of that cycle, but given where the rating level is, but the pressures are still there. For the most part, when we think about Latin America and the commodity cycle, actually you could argue they had a reasonably good commodity price cycle in that when commodity prices fell, we did not see that many downgrades, maybe not as many as you might have expected at the outset. Different kind of policy response in Latin America versus, say, the Middle East or even Central Asia, where in Latin America a lot of the adjustment was on the exchange rate rather than trying to defend an exchange rate. So the balance of payments adjusted, the foreign exchange reserve levels were maintained, and from our perspective, that kept some of the ratings up. Middle East and Africa, higher debt levels across the whole region, sub-Saharan Africa as well as the Middle East. You can see this is where we have a disproportionate number of negative outlooks, so that would suggest that we would probably continue to see more downgrades in this region. Still adjusting to lower commodity prices, and the best evidence of that is the fact that just in the last few days, Angola has changed its exchange rate regime. It's a little late, better late than never, I suppose, but the adjustments are still being made in the region. And in terms of what the policy response might be to higher oil prices, you can look at what Saudi did over the weekend. They've told us all along that their fiscal approach would be different going forward, i.e. they wouldn't just increase spending when revenues go up, but now we see higher oil prices and you've seen an adjustment to the public sector pay and military pay. This could cost as much as 2% of GDP. So, some doubts, I suppose, about whether or not the commitment to the kind of fiscal adjustments that we've been talking about at lower oil prices will be maintained, but we don't have a negative outlook on Saudi Arabia. I just use it as an example. So what might we see in 2018 in terms of actual rating changes? How many upgrades or downgrades might we see? Well, on the left-hand side, this is just a net positive outlooks for emerging markets and developed markets. We're kind of moving towards zero for both of them, so it looks relatively balanced. Chart on the right-hand side, The line is the number, call it the net improvement in debt. This is simply the number of countries where debt is going to fall, debt to GDP, minus the number of countries where debt is going to rise. And you can see what we forecast for 2018 is that number goes above zero. So we have around 20 countries more that are going to have debt to GDP in decline this year than debt to GDP rising. So this is the first time we've had that in a decade. And typically when we see that kind of activity in terms of debt to GDP, you can see what that means for rating changes. So if our forecasts are right and debt to GDP is falling in more countries than it is rising, you would expect, if this relationship still holds, to see more upgrades than downgrades. That's the blue bar for 2018. So what about higher interest rates? What does that mean for the sovereign world? This is probably the most important chart in this presentation by far. And what it shows you on the right-hand side is the change, and this is for all developed markets. Each dot represents a country. And it's the change in interest payments as a share of GDP over the last 10 years. That's the horizontal axis. And when countries are moving to the left, that means interest payments as a share of GDP have been falling. You can see more countries are to the left. And on the vertical axis, it's showing you the change in debt to GDP. And the change in debt to GDP, you can see, is positive. So debt has been going up, but interest payments have been going down. So this is rather unusual, one could say. And this is what we would maybe call the gift from central banks. So lower policy rates, pushing market rates lower, and higher debt levels have not resulted in higher interest payments. In fact, interest payments have come down. So what have they done with the money? That's the big question. So you look at the left-hand side, same horizontal axis. This is interest payments as a share of GDP. So the countries are, again, to the left. And now on the vertical axis, it's the change in non-interest spending over the last 10 years. And you can see that most countries, you can see an increase in non-interest spending, which is larger than the savings on the interest spending side. In fact, it's several times larger. So what this means is that debt levels are high and the fiscal savings associated with lower interest rates has already been spent. So as interest rates move up, there's going to be some fiscal challenges going forward. Again, not likely to see it in 2018, but as the effective interest rates that governments pay goes up, then there will be fiscal pressures, and then the political debate comes into it, et cetera. So how much money have Eurozone governments actually saved? We did a very quick calculation. If interest rates had stayed at 2007 levels from 2007 to 2017, and we didn't have the big decline in rates, and debt levels had gone up at the same pace in the Eurozone, we estimate that somewhere interest payments would be around €1 trillion higher than they were over that 10-year period. That's something like 0.8% of GDP per country per year on average in terms of the savings. That's a big, big savings. So if that goes into reverse, that's the kind of savings that the governments will be looking for going forward. It's a big number, so something that we need to be very focused on. Gross borrowing, gross government borrowing in 2018. Developed markets on the left-hand side and emerging markets on the right-hand side. This is showing you the deficits plus the debt that falls due that needs to be rolled over. And you can see that Japan is on the far left. They borrow almost 45% of GDP every year, the government of Japan. It's an enormous amount. So you could suggest that if interest rates go up in Japan, there's a very quick response in terms of Japanese fiscal dynamics. But there's a number of other countries, Belgium, US, Italy, Spain, France, that are borrowing more than 15% of GDP every year based on the deficit and the debt that falls due. Right-hand side is emerging markets. You can see the bars are actually a little bit lower. The deficits are higher, but the debt is lower. So the amount that needs to be financed as a share of GDP on the whole is a bit lower. But we have to think about two other risks for the emerging markets. One is they're not always borrowing in their own currency. A number of them are borrowing in dollars. And I've identified a couple of those countries on the box at the bottom. Argentina, borrows in dollars. Ukraine largely borrows in foreign currency. These are, single B credits, so you would expect to see more borrowing in foreign currency than local currency. And there's a number of other countries where non-resident holdings of domestic debt, even if they're borrowing in their own currency, there is a balance of payments dynamic to it because non-residents hold the debt, and there's a possibility of that money moving out of the country if interest rates move higher. So, and I've identified a couple of those, but Indonesia, Malaysia, Romania, Peru, they're on the chart, which you can see. One last thing to think about from an emerging market perspective is the external financing requirements. So if there is an increase in U.S. rates such that money is attracted back to the U.S., or people begin to anticipate a tightening of policy in Europe and money moves back to the Eurozone, which countries, which emerging markets might face external financing issues. And so this is what we call the gross external financing requirement for emerging markets. We've got it in dollar terms on the horizontal axis and as a share of foreign exchange reserves on the vertical axis. And in dollar terms, the largest economies have the biggest financing needs, no mystery there. And on the vertical axis, it tends to be sort of single B type credits that are up at the top left. So as a share of foreign exchange reserves, their borrowing requirements this year quite high. Again, single B, so that's what you would probably expect. I suppose the ones that we kind of focus on, number one, Turkey, which has always got a very high gross external financing requirement. But others are, Poland, Malaysia, Indonesia. Argentina's number is big in dollar terms and relative to foreign exchange reserves. So that's an issue worth thinking about as well with the higher interest rate world. Last slide I've got is really to think about the politics and political politics and policy risks associated with that. Developed markets on the left and emerging markets on the right-hand side. And as I mentioned earlier, the U.S. as a country we're very focused on. I suppose it's really what we're focused on is trade more than tax. And the trade agenda in the U.S., I suppose there's two things worth pointing out. One is NAFTA, two is China. On the NAFTA front, it seems, I don't know how closely people follow that here, but the consensus view in the U.S. seems to be gravitating towards if there isn't meaningful progress in the round that is going to be upcoming in Montreal later this month, the U.S. may announce a withdrawal from NAFTA later this month. This has become sort of an expected, if not consensus view in the U.S. So we could see quite a dramatic announcement towards the end of the month on NAFTA. On China, there are a couple of cases that the U.S. government is working on, solar panels, intellectual property. So we could see the implementation or the announcement of tariffs being implemented on China in the not too distant future as well. State of the Union address is at the end of this month, and there's some expectation that a much more aggressive trade policy will be announced by the U.S., not just rhetoric, but actual policy changes. So definitely things to look at there. I suppose there are a couple of fiscal issues just quickly worth mentioning. One is that the appropriations bill that is currently funding the government ends on the 19th of January. The government could shut down if they don't get a new appropriations bill. We think they probably will get one, although the issues are slightly contentious as usual. The White House seems to be focused on the wall with Mexico and getting Congress to pay for that, at least in the short term. And Congress is looking for this, at least the Democrats in Congress looking for the dreamers, the immigration issues to be addressed. We think there's probably room for compromise, if only because it's midterm elections later this year. Nobody wants to be seen as obstructionist in that kind of environment. And the debt ceiling. The debt ceiling is going to come back in March, so that's something to watch as well. UK is another one we've got listed here. Brexit, obviously. Not sure I can really add much to your understanding of that. We're as close to it as anybody, and none the wiser as to how it all turns out. But there is clearly a risk that if this year is critical for the negotiations, and if there isn't progress, or if it looks like things are sliding backwards, you could see a reaction in financial markets more dramatic than what we've seen, and probably play out in the exchange rate more than anything else, but certainly something to watch for. Italy, the elections, I think a lot of people focused on that. I think if we would have had this discussion a year ago, we would have been potentially worried about Italy leaving the Eurozone. That seemed to be a topic of discussion. That seems to be on the back burner now. The concern would more likely now be on the fiscal outcome of the elections. There's a lot of talk about fiscal easing, flat tax proposals, so the deterioration in public finances that led us to downgrade Italy last year may not be over, and we'll see how that turns out. The Eurozone itself, the need for reforms. President Macron has a reform agenda. He can't really get that started without a German government, so that doesn't seem to be going anywhere quickly. And on the right-hand side, two elections that matter more than any other in emerging markets this year. Number one, Brazil, and number two, Mexico. Brazil, it looks like if former President Lula runs, he probably wins. I mean, he's been ahead in the polls for quite some time. It's just not clear if he's going to be able to run because he has criminal charges that need to be put aside or addressed somehow in order to make him eligible. And if he does win, then we think that the fiscal challenges that Brazil faces and has not yet addressed, it makes them less likely that they will be addressed. So that's slightly worrying. And in Mexico, there is a candidate who's run a couple of times previously who looks to be well positioned for the elections this year. And that could be a step backwards in terms of some of the reform initiatives that Mexico has undertaken in the last few years, more of a nationalist, populist kind of agenda there as well. And there's a couple of other flags down there, which will test your flag knowledge really more than anything else. So you got Colombia, Malaysia, Thailand, and Hungary. So a number of other elections to be focused on. The big geopolitical risks, no mystery there. Middle East, so Iran and Saudi Arabia, potential for oil price spikes, and then North Korea. And I suppose when we think about the North Korea issue, it's really in the context of what that might do to U.S.-China relations. And does that drive a wedge between the U.S. and China and make a response from the U.S. in terms of trade policy all the more likely if they don't get some kind of mutually agreed approach to North Korea.